Hello, fellow economists and finance enthusiasts. Welcome back to our channel, where we delve into the intricate world of economics. Today, we embark on an enlightening journey to unveil the secrets of how banks set the exchange rate. Join us as we decode the puzzle of exchange rates, revealing the hidden factors that shape economies and impact our very own pockets. If you're as passionate about economics as we are, don't forget to hit that subscribe button and ring the notification bell to stay updated with all our insightful content. Get ready for an insightful journey into the realm of finance as we unravel the truth behind the valuable knowledge to navigate the currents of international finance with confidence and understanding. Let's get started. International currency exchange rates demonstrate the value of one currency in terms of another money. These rates can either be floating, fluctuating constantly due to various factors, or pegged to another currency. When currencies are pegged, they still fluctuate, but their movements are synchronized with the money they're pegged to. Understanding the value of a domestic currency concerning various foreign currencies is crucial for investors, as it allows them to evaluate assets priced in those foreign currencies. For instance, U.S. investors benefit from knowing the dollar to euro exchange rate when considering European investments. If the U.S. dollar is weakening, it can enhance the value of foreign investments, whereas a strengthening U.S. dollar can adversely impact the value of foreign investments. This exchange rate knowledge plays a significant role in making informed investment decisions in international markets. How are international exchange rates set? Floating versus fixed exchange rates. Currency prices can be established through two primary methods: a floating rate or a fixed rate. A floating rate is determined by the open market, where the forces of supply and demand on global currency markets dictate the currency's value. If there is high demand for a particular currency, its value will increase. Conversely, if demand is low, the currency price will decrease. Various technical and fundamental factors come into play, influencing people's perception of a fair exchange rate and adjusting their supply and demand accordingly. After the collapse of the Bretton Woods system between 1968 and 1973, most of the world's major economies allowed their currencies to float freely. As a result, exchange rates are not fixed, but continuously shaped by the ongoing trading activities in the world's currency markets. This system enables currencies to adapt to market dynamics, reflecting the changing economic conditions and international trade relationships. Factors that influence exchange rates. Floating rates. Floating rates shaped by supply and demand. High demand for US dollars boosts the price compared to the euro. Geopolitical, economic factors impact rates. Interest rates, unemployment, inflation, GDP, manufacturing, commodities. Fluctuations reflect economic health, influencing currency demand globally. Rates constantly change due to these factors. Fixed rates. Government sets fixed or pegged rates via central bank, linking currency to another. Floating rates fluctuate based on speculation, supply, demand. Central banks intervene during extremes. High or low values hurt economy, so governments realign to ensure stability. Macro factors. Macroeconomic factors drive rate fluctuations. Law of one price and purchasing power parity impact rates. Interest rates, prices, geopolitics, and stability matter. Investors track these for smart forex decisions. Forex and commodities. Currency-commodity link crucial in forex. Canada, oil, and Australia gold show strong correlation. High commodity prices raise currencies versus majors via exports. Correlations shift due to economics, geopolitics. Alert investors analyze for informed decisions. Understanding connections aids in navigating forex complexities, interpreting market moves and currency fluctuations. Maintaining rates. Countries may choose a pegged rate set by the government, not fluctuating intraday but adjusted on revaluation dates. Emerging markets use this to stabilize their currencies. To maintain stability, the government holds substantial reserves of the pegged currency, controlling supply and demand changes. What factors affect foreign exchange rates? Factors that affect foreign exchange rates include the political climate of a country, inflation, public debt, GDP, confidence, central bank and government intervention, and the balance of trade. Now let's talk about Asia financial crisis of 1997, when a lot of Asia countries' currency depreciated. What was the Asian financial crisis? The Asian financial crisis, Asian contagion, began in July 1997. It started in Thailand when the government ended the local currency's peg to the US dollar due to speculative pressure. Malaysia, the Philippines, Indonesia followed suit, letting their currencies fall. By October, South Korea faced a balance of payments crisis and neared default. Economies with strong fundamentals and hefty reserves fared better. Hong Kong, with a pegged currency and massive US dollar reserves, thwarted speculative attacks. Impact of the Asian financial crisis. Asian crisis currencies fell, capital inflows slowed. Thai baht went from 26 to 53 versus USD. South Korean won fell from 900 to 1,695. Indonesian rupiah plummeted from 2,400 to 14,900. Severe recessions hit affected countries. Indonesia, GDP dropped from 4.7% to minus 13.1%. Philippines, 5.2% to minus 0.5%. Malaysia, 7.3% to minus 7.4%. South Korea, 6.2% to minus 5.1%. Crisis led to President Suharto's collapse. IMF, World Bank intervened with $118 billion bailout. Reforms included stronger financial systems, lower debt, stable currencies via interest rates, and reduced government spending. Case study for market interconnection, currency trading, national accounts management. Causes of the Asian financial crisis. The crisis was rooted in industrial, financial, and monetary policies and investment trends. Markets reacted strongly. One currency after another came under pressure. Problems included current account deficits, high foreign debt, climbing budget deficits, excessive bank lending, and imbalanced capital flows. Policies to promote export-led growth led to risks. Government guarantees and political support masked investment profitability. Cozy relationships between local conglomerates, financial institutions, and regulators increased moral hazard. Foreign money flowed in with little attention to risks, leading to investment in unsound projects. Impressive economic growth masked vulnerabilities. Rapid domestic credit expansion, poorly supervised, created leverage and loans to dubious projects. Rising real estate values fueled by easy credit worsened the situation, along with current account deficits and external debt buildup. Currency pegs masked exchange rate and funding risks, exposing companies to insolvency when the pegs collapsed. Many Asian economies slid into current account deficits due to heavy government spending to support export growth. Why do governments keep exchange rates high? Governments, especially in developing economies, manage exchange rates to handle foreign currency-denominated debts. To attract investors, they issue bonds in stable currencies like USD, JPY, or EUR. However, if the domestic currency weakens against the debt currency, debt effectively increases as more local currency is required to pay it. For instance, when the Thai baht lost value in 1997, local borrowers needed more baht to pay USD-denominated debts. Higher value local currencies make imports cheaper in local currency terms, affecting countries reliant on imports. Why do governments keep exchange rates low? Governments may aim to maintain low exchange rates to boost export competitiveness. In the 1980s, the US government convinced Japan to allow its currency to appreciate through the Plaza Accord. The yen's value increased from 250 yen to 1 USD in 1985 to less than 130 yen by 1990. Consequently, the US trade deficit with Japan decreased from $55 billion in 1986 to $41 billion in 1990. In summary, currency prices are determined by fixed rates or floating rates. Fixed rates are pegged to a specific currency, while floating rates fluctuate based on market demand. Countries may intervene to maintain strong currencies and high demand in foreign exchange markets. As we come to the end of this illuminating exploration, we hope you now have a clearer understanding of how banks set the exchange rate, a fascinating world where the ebb and flow of currencies shape the global financial landscape. Armed with this knowledge, you are better prepared to make informed decisions in an ever-connected world. Remember, the intricacies of exchange rates continue to evolve, influenced by a myriad of factors. So, stay curious, Stay informed and keep seeking knowledge to navigate the dynamic seas of international finance. Thank you for joining us on this journey, and until we meet again, may your financial horizons be bright and prosperous.